Welcome back to the deep dive. Today we are taking a scalpel to one of the most critical structures out there, the legal framework of Indian banking.
A topic that can feel a bit dense.
Exactly. So whether you're prepping for a meeting or you just want to understand what actually gives banks their power, we've distilled all the core acts, the amendments, everything into what you really need to know.
And our mission really is all about clarity. We have to start with the two historical legal pillars that hold this whole system up. That's the RBI Act of 1934 and the Banking Regulation Act of 1949.
Okay.
And understand the difference between them, the law for the central bank versus the law for commercial banks.
Yeah.
That's the key. If you get that, everything else falls into place.
And this isn't just a history lesson. We're jumping straight into what's happening now. The Banking Laws Amendment Act of 2025, it's kicking in this August.
And it brings some genuinely surprising changes.
It really does. We're going to look at a very elegant, consumer-friendly fix to the whole nomination process. And then there's this financial threshold change that is, well, it's just staggering.
So let's start with that foundation. Those two acts, you have to understand them side by side.
Okay, so pillar number one. This has to be the master regulator, the ultimate authority. The Reserve Bank of India Act 1934. This is the charter that created the RBI.
That's right. And its main purpose when it was established was actually pretty simple but profound. It was to regulate the issue of banknotes and to keep enough reserves to secure, monetary stability.
Think of it as the financial constitution for the country.
Exactly.
And we see that power every single day when we handle cash. The RBI has the exclusive power to issue currency notes. Is that totally absolute, or is there that little exception we should remember?
There's always that one little exception. The 1 rupee notes and all the coins, those are actually issued by the Ministry of Finance.
Whoa.
But for everything else, that exclusive power gives the RBI direct control over the money supply, which means it has this huge lever to pull when it comes to inflation and the value of the currency itself.
So if the 34 Act gives the RBI control over the flow of money, it must also give it the power to act as a backstop in a crisis.
Absolutely. And that's one of its most critical roles. The lender of last resort.
The ultimate safety net.
It is. If a bank faces a sudden catastrophic liquidity crisis, say a bank run, the RBI has emergency lending powers to step in and support them.
So one bank's failure doesn't become a whole system collapse.
That's the idea. And the RBI Act also gives the central bank another tool for stability. Reserve requirements. This is where we get the cash reserve ratio, or CRR. It's a stability measure. It dictates the percentage of a bank's NDTL, that's net demand and time liabilities, that the bank must keep as cash with the RBI.
Okay, let's just quickly break down NDTL for anyone who's not, deep in this stuff. What does that actually represent?
Good question. In simple terms, it's the total money a bank owes to its customers. The demand part is money you can pull out instantly, like from your checking account.
Got it.
Time liabilities are things like fixed deposits, funds that are locked in for a period. The bank takes a set percentage of that total, the NDTL, and parks it with the RBI.
And here's the crucial part, right? The bank earns zero interest on that CRR money.
Zero. It is purely for regulatory control. It's not an investment.
Okay, that sets the stage perfectly for Pillar 2 then. If the 1934 Act is all about the master regulator, the 1949 Act must be about the day-to-day business of banking.
Precisely. Pillar number 2 is the Banking Regulation Act of 1949. This is the operational Bible for every commercial and cooperative bank.
And it starts with the most basic definition.
It really does. Section 5B defines banking as accepting deposits from the public for the purpose of lending or investment. That's it. That simple line is the foundation for everything.
So the 49 Act is really the gatekeeper.
The ultimate gatekeeper. No company can even think about starting a banking business in India without a license from the RBI under this act. It's how they enforce standards from day one.
Okay, so we just talked about the zero interest CRR under the RBI Act. Now, under this act, the BR Act, we get its twin, the SLR, or statutory liquidity ratio. How are these two different?
That's the essential contrast to understand. SLR is cash held by the RBI. SLR is a percentage of that same NDTL, but the banks keep these assets themselves.
Ah, so they hold on to it.
Yes, they hold it in the form of gold, government securities, or just vault cash, liquid assets.
So if I am a bank, this means I can actually invest my SLR portion into something like a government bond and earn a return on it, whereas my CRR portion is just sitting there earning nothing. Is that the right way to think about it?
That is the perfect way to think about it. SLR provides liquidity for the bank, but also lets them earn a small, safe return. CRR is just pure restrictive control over the money supply.
And the BR Act also has general oversight powers.
Oh, yes. The RBI can inspect any bank's books, anytime. It sets the rules on minimum capital. It's comprehensive.
And it also protects forgotten money. We should probably mention the DF Fund.
Yes, the Depositor Education and Awareness Fund. It's crucial. Any deposit that's been unclaimed for 10 years or more goes into this fund.
So even that money is managed safely by the central bank.
Exactly. It doesn't just disappear.
All right, let's pivot from the historical framework and jump straight to the updates that affect you right now. The Banking Laws Amendment Act, effective August 1st, 2025.
And the first change is a big one for consumers.
Yeah.
Nomination rules. The old system was so restrictive, you could only have one nominee per account.
Which was a nightmare for estate planning.
Total nightmare.
So the new provision is a huge quality of life upgrade. You can now have up to 4 nominees, and they can be simultaneous or successive. It just simplifies inheritance so much.
It really streamlines the whole process.
Yeah.
A simple legal fix, but it has enormous practical value for people.
Definitely. But the next change, this is the one that really stands out. The threshold for defining substantial interest in a banking entity.
This is a huge leap.
The old standard was what, 5 lakh rupees?
5 lakhs. And it's now been revised all the way up to 2 crore rupees.
That's a 40-fold increase. It's a fundamental rethinking of what substantial even means in today's economy.
It is. I mean, 5 lakhs just doesn't represent a significant stake in a multi-billion-dollar operation anymore. This revision tells you the law is finally catching up to modern asset values.
Makes sense. Now, beyond the money, the amendment also tweaked governance and talent. For co-op banks, director tenure went from 8 years to 10.
Right, which is clearly aimed at better continuity, more institutional memory.
And for public sector banks, the PSBs, there's a big audit reform.
This is critical. Before, their auditor pay was often fixed. Now the PSBs can set their own compensation. The explicit goal is to attract top-tier audit talent to these systemically important banks.
And one last small but important update on unclaimed shares.
Yes, those now get transferred from the bank's books directly to the Investor Education and Protection Fund, the IEPF. Just cleans things up.
Okay, so moving away from the main pillars and amendments, we have to talk about the supporting legal ecosystem. The laws that give banks their teeth, especially when it comes to recovery.
And that brings us straight to the Sarfazi Act of 2002.
The acronym alone sounds intense. What power does this act give banks that so fundamentally changed the game?
Sarfazi is all about recovering non-performing assets, NPAs, bad loans. Before 2002, a bank had to spend years fighting in civil court to get its money back.
A very slow process.
Incredibly slow.
Huh.
This act gives banks the power to recover bad loans by seizing and selling the assets that were put up as security. And here's the kicker, without court intervention.
They can just bypass the courts.
They can bypass that whole lengthy judicial process. It gives them immense power to clean up their books quickly.
It's a critical feature of the modern system, really,
Yeah.
prioritizing the speed and security of the financial institution.
But on the other side of that power, you have the core protection for you, the depositor. That's the DICGC Act of 1961.
The Deposit Insurance and Credit Guarantee Corporation Act. This is your absolute safety net. So if a bank fails, what are we guaranteed?
Currently, that insurance is up to 5 lakh rupees per depositor, per bank. It's a huge psychological safeguard. You know that up to that amount, your money is safe, even if the bank collapses.
It prevents panic.
Exactly. And then beyond crisis management, you have the laws for just daily transactions.
We should briefly touch on the Negotiable Instruments Act of 1881.
Right, this is the really old one.
It's the foundation for checks, promissory notes, bills of exchange. And the one thing everyone should know is Section 138 of this act. That's what deals with check bounce cases, and it carries serious legal weight.
And of course, for anyone doing business internationally, there's FEMA.
Yes, the Foreign Exchange Management Act of 1999. It replaced the old, much stricter FIRA. FEMA regulates all foreign currency transactions, trade, payments. It's all about keeping the national currency stable. Okay, so to bring all these mechanics together, let's do a quick review of the major rates and ratios. This really summarizes the control mechanisms we've discussed.
Absolutely. So first, you've got the tools the RBI uses. The big one is the repo rate. That's set by the Monetary Policy Committee. It's the rate at which the RBI lends to banks.
This is their main tool for inflation, right?
It's the primary lever for controlling inflation across the entire economy. Then you have the reverse repo rate, which is the opposite. The RBI absorbs extra cash from banks. It's more of a liquidity management tool.
And the bank rate.
And the bank rate, which is for longer-term lending.
So just to hammer the point home one last time, the structural difference.
The CRR from the 1934 Act is cash held with the RBI earning zero interest for stability.
And the SLR.
The SLR from the 1949 Act is liquid assets kept by the bank itself, which can earn interest. That's for the bank's own liquidity. If you get that split, you get the purpose of the two legal pillars.
So at the end of the day, what does this all mean? We've seen this essential framework. You have the central bank's control from the RBI Act of 1934, and then you have the commercial rules of play in the BR Act of 1949. And we've seen how the 2025 amendments are really modernizing things, from something as simple as depositor nominations to that massive 2 crore interest threshold jump.
And that really raises, I think, a final question for you to consider. How do you balance the immense powers designed to secure the whole system, like the RBI's role as lender of last resort, against the powers designed to protect a single bank's bottom line, like the Sarfisi Act's power to seize assets without a court order?
That's the tension right there.
It is a complex interplay, the constant balancing act between system-wide protection and accelerated recovery for the institution. That is the fundamental tension that keeps the entire Indian banking ecosystem running.